This video will discuss the Consumer Price Index and inflation. We'll specifically discuss reasons for tracking consumer prices, discuss the CPI, which is the Consumer Price Index, and its methodology, use a simple example to compute the CPI and the inflation rate, discuss problems with measuring the cost of living, compare and contrast the deflator, the GDP deflator that we discussed in a previous video, to the CPI, show how to meaningfully compare economic variables over time, and compare nominal versus real interest rates. Now, before we go further, let's actually look at what the Consumer Price Index looks like over time. So here we have it. I graphed it out from 1980 to 2020. The index started out at 80 in 1980, and it went all the way up. You can see it creeping up there, all the way up to 260 in 2020. Now, first off, the level of that is not that important. It depends on when the base year was. We usually set the base year to be 100. And so here it looks like around 1983 or so, the base year was set to 100. We'll talk more about that. But what we really are interested in is the trend, not the level, but the trend in this index, which measures that trend. It has a growth rate, and the growth rate is inflation. That's the important part of this index. Now, this is the Consumer Price Index for all urban consumers, all items in U.S. cities, and it's an average. And so it's computed by the Bureau of Labor Statistics. And, let's note here, so remember the shaded areas are recessions. And so if you look really carefully, and it's hard to see when you have it in this type of level, you need to zoom in and calculate the inflation rate, which we'll show you how to do in a little bit. But if you notice right here, to be in the early 80s, the late 80s, early 2000s, 2008, 9, 10, and before that, you notice that there's a ramp up in that CPI index, which means inflation tends to be ramping up a bit right before recessions, and then recessions hit. Prices tend to drop off, and you can see the drop off in prices in 1983-ish or so. It drops off, at least the trend drops off a little bit in the early 90s, in the early 2000s, and you can certainly see what is deflation, negative inflation rates. The CPI actually dropped in the Great Recession. And so those are important items that we need to look at and discuss. So now let's look at actual consumer inflation, the growth rate in that index I just showed you a second ago. You can see, first off, let's first look at the patterns around recessions, and I'll get to this big drop-off here in a moment. Notice what happens after recessions. The inflation rate tends to drop off. It's still positive. We're still in positive territory, but it drops off. So the inflation rate drops off, creeps up before. So you're creeping up before a recession, drops off, creeps up before, drops off, creeps up a bit, and even during, and then drops off and actually went negative. That's the disinflation we saw. And then ramps up a bit afterwards. And here we are, steady just around 2%-ish or so. Now this is a story in and of itself when we get to monetary economics and the Federal Reserve and money supply. What we had is notice the inflation rate was 15%, even higher at points in time in the early 1980s. And that was excessively high. The distortionary effects are huge. We'll talk a bit about that. But what happened was the Federal Reserve became committed to bringing that inflation rate to a reasonable amount. And so what it did was it cut the money supply in the U.S. economy. That's something, again, we'll study a little later on when we talk about the Federal Reserve and the money supply. It turns out that the amount of money that floats around in the economy, the amount of dollar bills is currency, and how much money we have in our checking account, that's the money supply. Turns out that has a huge impact on prices, because let me just give you a simple example. It's a thought experiment. If overnight we doubled the money supply in this economy, what would happen in general? Just assume that it could happen. Well, we would get up and go to work like we would any other day and produce about the same amount of goods and services, except there'd be twice as much money out floating around. What that would mean is prices would double. The prices of goods and services would double. Our wages would double because wages are a price of labor, and so on. And so what ultimately happens is when you have really high inflation, it's ultimately tied to a high increase in the money supply. And so our money supply was needed to be put under control, gotten under control. And that's what Paul Volcker, the Federal Reserve Chairman, did in this time period. And look, he brought down the inflation rate down to 2.5%. And things went much smoother afterwards. Now what we want to do is, let's ask the question, why track prices? Well, because the growth rate in prices tells us inflation. We've just gone through that. Salaries need to keep up with inflation because we need to know if we're gaining or losing in terms of purchasing power with our salary. And that kind of makes sense. And that's probably why the Bureau of Labor Statistics keeps track of inflation and prices and the price index. Indexes, there's more than one. We'll primarily look at the consumer price index and the GDP deflator a little bit later on. Interest rates also need to reflect inflation, because if interest rates don't properly reflect expected inflation and actual inflation, there will be distortionary transfers or effects between borrowers and lenders that will cause the financial markets to grind to a halt. People just won't lend if they don't get a reasonable return for their money. And people won't borrow either if the costs are too high. So it's important that interest rates properly reflect inflation. So we need to measure inflation. Then we have a stable money supply, as I said a minute ago, is an important factor in stable inflation and stable interest rates. So kind of what you're seeing here is ultimately inflation, long-term inflation, is caused by money supply and money supply growth. And that if you want stable inflation, which means stable interest rates, you need a stable money supply. And when you have a stable money supply, stable interest rates, stable inflation, guess what? You got a stable economy, which is what we want. Let's further motivate why we're tracking prices with a wage problem. Suppose you started working 5 years ago for a salary of $43,130 per year, and you now earn $50,000, having received 3% raises each year. Are you better off than you were 5 years ago in terms of purchasing power? Meaning, can you buy more goods and services with your salary after 5 years? The answer depends critically on the inflation rate over the last 5 years. Suppose now that the Bureau of Labor Statistics estimates that inflation was 7% per year over the last 5 years. What is your purchasing power today? Let's move over to paper and pencil to answer this question. First off, let's make sure that we have a handle on the problem. I like to draw timelines, and we usually start out in these timelines, especially in finance, because money compounds and we need to take that into consideration, how it compounds. Here we have a salary of $50,000 at time zero. This is the future. So we're here at time zero. This is the future. This is the past. And we're going back 5 years. So you go -1, -2, -3, -4, 5 years. And back then we had a salary of $43,130. And we said, okay, it went from 43 to 50 at 3% growth in our salary. That was our wage increases. That's our salary. That's our raise that we had. And if we take it to the 1 plus the 3%, this is basic compounding of money, then 43,000 at 3% for 5 periods, yeah, that equals 50,000 approximately. So that works out. Now the question becomes, well, how does this work when we have inflation of 7%? This is what happened nominally in current prices. But what we want to know is what happened with the effects of inflation. Well, we know that things are growing at the 3%. That's the raise you got each year. So that's kind of like, that's how this is snowballing. Think of this as a snowball, and it's growing and accumulating to 50,000 at 3%. But when you have inflation, it's eating away at your wages and what you can buy in terms of purchasing power, what's called your real purchasing power. And it's kind of like rewinding the accumulation effects. And it rewinds at a speed of 7%. So it's growing at a speed of 7%, but it's declining at a rate of 7%. So if we track that, take it to the fifth power, that relationship, we'll get 35,649. That is our gain in purchasing power. Well, I should say decline in purchasing power. We could originally buy goods and services worth 43,000. Now we can only buy it a little more than 35,000. So we've dropped off nearly $8,000 in purchasing power. So understanding inflation and its effects are important, as you can see. And by the way, keep this in mind that there are distortionary effects going on here potentially. Let's assume that your employer's cash flow is growing at 7%. In other words, whatever product you're making with your salary, the business's selling price is growing at 7% at the rate of inflation. Okay, so that's kind of pretty much usual, but the employer is only paying you 3% in terms of wage growth. Well, what that means is your employer is gaining at your expense. So there's a transfer of wealth that's coming from you to your employer. To be fair, your employer, assuming that the prices of their goods and services are going up at 7%, they should be at least paying you 7% in terms of salary, in terms of raises. We'll talk more about why that might even be a little bit more than that normally under normal circumstances. So now what we want to do is look closely at the CPI methodology and how does the Bureau of Labor Statistics actually go about estimating the consumer price index and inflation. Well, it tracks a fixed basket of goods and services purchased by a hypothetical person, the average person. And roughly the basket's composed of 42% housing, 16% transportation, 15% food and beverage, medical care 8%, education and communication 7%, and 12% other. Now here's how I like to explain it. So here's that's basically the quantity of or what we'd call the weights behind the prices. So there's a price associated with housing, there's a price associated with transportation, and so on. So those are the prices, but we need to weight them because the average consumer spends a portion of their money based on those items. So you need to have the proper weights. And so what we're saying here is the weights are approximately 42% housing, 16% transportation. Now here's another way of looking at it in a very simple manner. Suppose you have a shopping list of 10 items and it's very explicit. It's exactly the size, the type of food that you want, or the type of good that you want. It's very explicit. So you go to the supermarket. Suppose you can buy transportation, housing, food and beverage, Medicare, and everything in a supermarket. So on January 1st, you go and you buy all 10 items that are on that list exactly, and you check out at the cash register and they tell you that it's $100. Okay, $100. Now, 1 year later, you go and you buy the exact same items on that list. There's no substitution. In other words, if you're walking down the aisle and you see something's on sale, you don't substitute. You buy and you stick exactly with that list. Let's say when you check out at the end on December 31st, when you check out, the cost comes out to be $110. Well, nothing has changed except prices. That's what we mean by inflation. Now let's continue with a specific example. Suppose that there's just two items that the average person consumes, and that's coffee and donuts, cups of coffee and number of donuts. And here we have the price of donuts for year 1, 2, and 3, and we have the cups of coffee. Notice cups of coffee are 14 cups of coffee. Think of this as on a weekly basis or annual basis. It doesn't matter. It's just a consistent time period. And then we have donuts, and you have the price of donuts, and then you have the number of donuts, 7. So notice the basket of goods has not changed. It's fixed. What you notice is prices are changing. So what we want to do is we want to compute the cost of the basket, in other words, the index each year. And that index is price times quantity. And we're going to add it up. And so we're going to do it for each year. And then from that, we'll calculate the growth rate of that index, which is called inflation. And then we'll compute the average compound growth rate over the 3 years. That's average inflation. Then we'll compute the index each year, assuming year 2 as the base year. So here we have year 1, and we have $2 times 14 cups of coffee, year 2 and year 3. And then we're going to have donuts, $1 for a donut times 7 donuts. The cost of the basket is $35, or you can think of that as the index. The next year, the index is 56. Okay, or the price of the basket is $56. And then the next year, the last year we have here, the cost of the basket is 77, or the index is 77. Now, you could think of, like I've been calling it, you could think of this as the index, or this is the cost of the basket. Often indexes, when they're started, people like to see nice round numbers associated with it. So, and they call that a base year. So let's translate this into a nice simple base year, starting out with 100. So all we're going to do is we're going to take this 35 and divide it by 35 and times 100. And what do you know? We get 100 because that's 1. That's pretty straightforward. Okay, but the index, notice the index is starting out at 100. All I did was I renormalized it from starting out from 35 to 100. And then I'm going to translate this number and renormalize it based on this initial 35. That's our base year. Multiply it by 100, and I'm going to get 160. And so now you can see one of the motivations for putting things in nice round numbers is you don't even need a calculator to see that what's happened is inflation has increased by 60%. It's kind of hard to see that it's 60% looking at these numbers, but here you can see it went to a nice 60% without a calculator. Now let's look at the last number. And so here's 220. And that turns out to be a 37.5% change. That's inflation. And here's a 60% change. That's inflation. So we had 3 years worth of data, 2 years of, two years worth of inflation, because we don't have enough data to calculate 3 years worth of inflation. So now we want to ask ourselves, well, what's the average inflation rate? Well, we could take the $77, divide it by the 35, take it to the 1/2 power, meaning that's the number of time periods we have here, the number of years that we have to change, the years, because inflation is the change. And then if we subtract 1, we'll get 0.483, and that's the average inflation rate, 48.3 in this example. Or we could have simply took the 220 divided by 100 minus 1, take that to the 1/2 power, and we would have gotten the same thing, 48.3. And you can check 100 times 1.483 squared equals 220. Okay, now, that's really not so bad. It looks like we're juggling around a lot of numbers, but it's intuitive. Okay, there's a bunch of different ways you can calculate this, but this is an intuitive. So calculate it however you like, but I think it's relatively intuitive. Now, let's renormalize or change the base year to year 2. Let's set base year 2. So we're going to take 35 divided by the 56, which is this year. This is our base year, times 100. Now the index is 6250. And then for the second year, 56 divided by 56 times 100. Oh, okay, look, and there's our base, 100. Base year starts out at 100, and then we get 77 divided by 56 times 100, 137.50. And so we renormalized, got a new base year, and this is again 60% growth. You can calculate that. That's the inflation rate, and this is 37.5% inflation also. So the point of all this is when you look at historical data and you look at the time series, you'll often find there's different base years. And those base years are not doing anything particular other than renormalizing the series. What's important is that the inflation rates are calculated and they're not changing. So no matter what base year you have, you're not disrupting inflation. Inflation is inflation. You can't try to fool around with it by renormalizing and developing new base years. So a little further on in this video, I'll show you an example of normalization and a particular base year application. Moving on, now what we want to do is compare the CPI versus the GDP deflator that we looked at in a previous video. Recall that the GDP deflator reflects all goods and services produced domestically. Remember, gross domestic product looks at the domestic product, stuff that's produced in our country. And the GDP deflator is designed to capture the inflation rate that's embedded or implicit in GDP. And recall, the deflator is the nominal GDP divided by real GDP, where the real GDP number is basically using base year prices adjusted for changes in quantities. Go back to the previous video and take a look at that. So what's happening with the GDP deflator, quantities are changing. With the CPI, the difference is it's a fixed basket. And it's a fixed basket that consumers face as when they're buying goods and services. The GDP deflator is focusing on production. So they're two different but very related data sets. Now, the discrepancies between the two often occur because of price changes in consumer goods versus produced goods. This happens often with imported goods, which show up in the CPI because as consumers, we buy Japanese cars, we buy Chinese products. So the CPI reflects those imported goods, but those goods are not showing up in our GDP deflator because they weren't produced here. So what's a good example that would highlight these differences? Well, let's look here. If we actually look at the GDP versus CPI and the deflator, you can see that they're pretty darn correlated over time, highly correlated. But take a look at, let's focus in on the 1973-74 recession that we had, which was caused in part by an oil shock. In other words, OPEC cut supply and prices rose. You can see there the blue line. So the blue line here is consumer price index, and the red line is the GDP deflator. Now look what happened. We had another oil shock that happened in the late 70s, and there you have the CPI shooting up. But in both instances, notice that the red line, the deflator, did not go up as much. This is because oil was more reflected in consumer prices than it was in production. It's embedded in production for sure, but it showed up more in the consumer price index. And then in the mid-1980s, the price of oil dropped significantly, which you can see the consumer price index dropping off dramatically, and then it picked up again. And then you see the same thing here. Oil spiked up in around 2008 or 9. It spiked up, and then it crashed from around $150 a barrel down to some very low number. I don't remember how low it went, but it went very low. And so there you have, you can see the consumer price index reflecting that drop in oil prices. Before we leave this graph, take a look at how much smoother the GDP deflator is compared to the CPI inflation rate. And one of the reasons for that is the CPI, while it captures a lot of products and items, like 80,000 or so that the Bureau of Labor Statistics tracks price. It tracks prices of 80,000 units or so, or different goods. Whereas the GDP reflects probably millions of different items. And so those millions of items smooth out the prices, the weights smooth out much better than compared to the CPI. Now let's move on and let's look at that. I made a reference to about looking at an example of renormalization or establishing a base year. So here what I have is I have an example of gross domestic product, nominal gross domestic product in current dollars going up in the blue line. And notice the base, it's starting fairly low here, and then it ramps up to almost 22,000. And that's billions, so that's like 22 trillion. And what we have here is we have the real gross domestic product adjusted for inflation. So notice it's much flatter because we wrung out the inflation component to it. But still, why is that increasing? Well, it's still increasing because there's labor productivity growth. People produce more goods and services with the same input. And also there's population growth embedded in there too. This is not per capita. But notice, these were both normalized right here at around 2012, 2013. They were normalized to not necessarily at a base year to set each at 100, which we could have easily done or they could have easily done, but it was set to normalize so that they were both equal in 2012 because that's their frame of reference in whatever question was being asked. They're asking, well, what happened since 2012? You can fast forward and look forward, and you can see the blue line ramping up more than the red. And then you can look back into the past and see how the differences in the slopes and the differences in the series behaved. Now let's look at adjusting economic variables for inflation. We've already done some of this, but let's look at another example that's interesting and it's related to what we just covered. Suppose the average person's salary, in other words, wages and benefits in 1980 was $10,000 per year, and that the CPI in 1980 was 80, and in 2020 it was 260. So the questions become, what was the average inflation rate from 1980 to 2020? And if the average salary kept pace with inflation, what would it be in 2020? And then I'm going to ask a question. Why would simply adjusting compensation, in other words, wages and benefits, just for inflation, typically underestimate the actual growth in compensation? I alluded to the answer to that a few minutes ago. We'll go over it again. So let's start out with the first question. What was the average inflation rate from 1980 to 2020? Let's move over to pencil and paper. So let's calculate the average inflation rate. Okay, the CPI started at 80, and it grew at an inflation rate, I'll call it X. Over 40 years, it compounded out to 260. So what we need to do is solve for X, that's the inflation rate. So that's not too hard. You divide both sides by 80, and it's 1x over 40 equals 260 over 80. Then take both sides to the 1/40th power. To get rid of this exponent, 1 plus x equals 260 divided by 80 to the 1/40th power. Subtract 1. X, which is our inflation rate, is 260 divided by 80, to the 1/40th power minus 1. And when we do that, we get 0.0299, which is about 3% average inflation rate for the last 40 years. And then if we wanted to look to see, well, what's the $10,000 translate to if it grows at the rate of inflation, right, for 40 years, right, what would that translate into? $32,500. So if we started out with a $10,000 salary in 1980, and if that salary simply kept up with inflation, it would be equivalent to $32,500 today. Now, the next part of the question we've covered before is now why is this 3% likely to be underestimate wage growth? And the answer is because not only does your salary keep up with inflation, but wages reflect your productivity. And that's a big statement in economics. And it refers to, on average, people's wages, their salary, reflects how productive they are. So if you're in a competitive market, then you're going to get paid about what you're worth on average. There's all sorts of exceptions to that, but by and large, it holds pretty good on average. And if it didn't hold on average, something would be amiss in our economy. So what I'm saying is productivity growth probably adds about 1% or more to it on average to this 3% inflation, which means that we can estimate what that labor productivity growth is on average over the last 40 years simply by taking a look at personal income. The personal income is very close to GDP. Remember, what's produced, the value of what's produced is somebody's income. But it's not quite that. There's slight differences. There's transfer payments that, effectively are taxes to some people, and it gets transferred to others, and that kind of washes out. There's also payments that come from the government in terms of interest expense because people own, it's interest expense to the government, but it's interest income to individuals because individuals own treasury securities, which are bonds issued by the government. But let's just take personal income as a pretty good estimate of GDP per capita. Personal income in 1980 was $9,843. In 2020, it was $57,404. And let's see what the growth rate of that is. Over the 40 years, the average growth rate was 4.5%. And so we're saying that inflation was about 3%. So that means that on average, labor productivity growth was about 1.5% per year over the last 40 years. Now that has gone up and it's gone down. There have been periods of time when that labor productivity was much higher in the 1990s, and then it came down lower. And we'll talk more about it as we get further into macroeconomics. Now, moving on, let's talk about problems in measuring inflation. There's a couple of problems. The basket is not really fixed, first off. There's substitution effects that are ignored. As I mentioned before, you're shopping with a fixed list of goods. Imagine going down the aisle and you want to pick out an item. Well, you're going to look at the items, and if you're looking carefully, there's probably going to be some items on sale that's going to attract your attention and probably cause you to buy them. Well, remember, the CPI does not reflect that substitution. It's going to buy exactly what's on the list. That effect alone is likely to overstate the CPI just a bit because the average consumer looks for bargains. And so the price index is actually a little lower than in reality than according to the index itself. Then also keep in mind that the Bureau of Labor Statistics has to incorporate new goods into the basket. So there's always new goods. iPhones came out over a decade ago. The Bureau of Labor Statistics was slow to get various items like mobile phones into their index. It's very hard to imagine the difficulties that the Bureau of Labor Statistics must have in trying to untangle quality effects versus quantity effects in things like a new car. Now let's move on to nominal versus real interest rate. From the Fisher equation, we know that the nominal interest rate, that's the interest rate you normally see advertised, equals a real rate plus an inflation rate. The real rate is usually hard to find. The inflation rate, we estimate, that's pretty well publicized. But what happens is we have a nominal rate, we have an inflation rate, and we back into what's the implied real rate. And that's what I'm doing here. I'm taking a treasury yield, a 3-month treasury bill that earns 0.117% per year. It's annualized, so everything's annualized here. So it's about 0.1%. And that has to equal the real rate of return, which I'll explain in a second, plus an inflation premium of 2%, because inflation is about 2%, and it's hovered around 2% recently, and we expect it to continue that way. When you do the math, it implies a real rate which happens to be negative 1.88%. But before we get into the negative part, let's talk about what real rates normally are and what they represent when they're positive. So real rates are typically positive, and what it represents is it's the income that a lender generates above the inflation rate. So you want to not only keep up with inflation as a lender, but you want to earn a little bit of return on your money. Your money can go a long way for certain people if you lend it to them. But you want to not only keep up with inflation, that's what the 2% inflation rate here is suggesting, and then you have the real rate. Now, under normal circumstances, that real rate is positive, but in today's world, the Federal Reserve has pumped so much money into the economy, has pushed interest rates, the supply of money up significantly, and the price of money has come down significantly. And so now that's why nominal rates are so low. And so the question becomes, okay, so real rates are not that hard to understand when they're positive, but how do we interpret this when we're looking at negative real rates? Well, here's how you look at it. The borrower, which is the Treasury in this example, its general cash flow, tax revenues, for example, are inflating by 2%. Any borrower, under normal circumstances, is in the economy, and the economy is inflating at 2%. That means the cash flow of the borrower in general is going up by 2%. But in this case, the borrower, the Treasury, is only paying 1.17%. Thus, the borrower Treasury is gaining about 1.883% per year from this transaction. It's like a negative borrowing cost to the Treasury. That seems like an interesting concept. Maybe that motivates the Treasury to borrow more money. Okay, let's move on. Now, as a lender to the U.S. Treasury, for example, you or I, we're losing 1.883% per year. So you can see there's a transfer between borrowers and lenders here. The borrower is making out with these negative rates because it's basically the real rate of borrowing is negative, and that means the real rate you get as a lender is negative, and so your purchasing power is declining from that situation. So why would anybody want to invest in securities that offer a negative real rate? Well, the alternative is this. And remember, you got to flip into the old opportunity cost story. What would happen if you didn't invest your money in those Treasury securities? Well, you'd be losing 2% at the rate of inflation, and losing 1.88% is better than 2%, but there's more to it than that. There are people with literally billions of dollars. They're portfolio managers, and they're looking for a place to park their money in a safe investment. So what are their alternatives? Well, they can go to a bank, but, well, wait a second. Banks are only insured up to $250,000. What about the other $1 billion plus that you want to put into that bank? If that bank goes under, you're not going to get your money back. And what about if you buy securities? Well, they're risky. What if you buy real estate? Well, it's risky. So the point is, if you want to have a safe return and keep your money relatively safe, you buy U.S. Treasury securities. It's kind of like what's called a safe haven effect. You move into the country's treasuries that are the safest. So U.S. Treasury markets are the most liquid and safe securities that are out there in the entire world. So when the money supply increases significantly and interest rates come down, as we'll see later on in the course, it means that lenders are actually losing out. And so that can actually hurt seniors, for example, because seniors, they have their money in various accounts. They're not earning much rate of return. In fact, the rate of return, when they're all said and done, is negative. And so savers are hurt. Savers are lenders, and the borrowers are gaining under these circumstances. The real interest rate is probably one of the most important variables in the whole economy, and it's extremely important to macroeconomics. The real rate is managed in part by the Federal Reserve. And when I say the real rate, notice in this slide I have the in quotes. There are many, many real rates. It depends on the bond. Every bond, every different maturity on a bond, all bonds have different real interest rates. But in economics, we simplify things by saying, look, there is a real rate in the economy, and conceptually that works very well. Now, it's this real rate that drives many of the components of GDP, and it drives it inversely. So when interest rates go up, economic variables go down. So what do I mean by that? Let's take a look at the slide here. When real rates go up, consumption goes down, and investment, even more so, investment drops. These two components are worth 85% of GDP, so it's important. So what happens is when real rates go up, borrowing costs go up. People, individuals, consumers, they use borrowings to pay for washing machines and automobiles and for consumption in general. And businesses borrow to expand property, plant, and equipment, to expand their businesses, and that's inversely related to real interest rates. And not only that, but again, as we saw earlier, mortgage costs, in other words, the cost of borrowing to buy a house, becomes more expensive when the real rate goes up. And mortgages drive housing, and housing is embedded in investment component, the I component of GDP. Now, it goes even a little further than that. When real interest rates go up in the U.S., for example, there are portfolio managers around the world scouring the earth for the best rate of return, the best real rate of return after you subtract out the inflation effect. They're looking for the best real rate of return. And so when interest rates in the U.S. goes up, the value of the dollar goes up because you have all these portfolio managers around the world converting their currency, for example, euros or yen, into U.S. dollars to be able to buy U.S. dollar securities that earn that high rate of return. So therefore, when real rates go up, the value of the dollar goes up. And if the value of the dollar goes up, we tend to import more because from our perspective as Americans, it's now cheaper to buy foreign goods. And our exports drop because from foreigners' perspectives, to buy our goods becomes more expensive with a higher dollar. Now, exports and imports total on an absolute value basis is almost 30%, so that's important. But consumption and investment is really important because it's much bigger. Therefore, we can summarize the effective GDP of an increase in real rates. GDP will decline, consumption will decline, investments will decline, exports will fall, imports, which have a negative sign in front of it, go up. And so you see, it's unambiguous, GDP falls. So as you can see from this video, price indexes, such as the consumer price index and the inflation that we can calculate from it, plays a very important role in economics. In fact, it's integral. So the discussion of inflation does not end with this video. It's going to play a very important role in the models that we develop going forward in this course.